Good morning. Welcome to another webinar. We call this webinar What's Up with the Market, and I'll give a market status update. Right, let's get into it. I've got to remind you, everything I cover here today is generic technical analysis. When we look at the charts, you do see the SPA3 Investor ATR TSL indicator. So there's a little bit of mechanical in it, but it's mostly generic. And everything I cover here is not used in SPA3 Investor or SPA3 Trader. And this generic technical analysis is used to make any decisions in the public portfolios, and nor in my own personal portfolios. I am a 100% mechanical trader, have been for decades now. If 2 plus is plural, and I follow our systems as well. I don't trade any other way outside of our systems. Right, I've got a beautiful quote today that I found, and I'd never heard of this gentleman. He happens to be Australian as well. His name is F.M. Alexander, and you may have heard of the Alexander technique. People do not decide their futures. They decide their habits, and their habits decide their futures, which I think is quite apt given all the discussion that we have and the training and learning that we have with James Clear and Atomic Habits. This gentleman came up with this years ago. He was born in the 1800s and originally from Tasmania. So let that one sink in. Okay, I have to remind you that everything we cover here today is going to be of generic investment advice. There's no personal or specific investment advice. Sorry, general investment advice is the ASIC term that I've got to use. Let's get into the analysis. Starting off with the Dow Jones. Wow, we've had some brilliant price action, and I'm not going to hold back on it today. Right, we have Dow Jones. First thing that comes to mind as soon as I look at this is the underperformance of the Dow Jones versus the S&P 500. And that is a very highly risk-on signal. Where when the S&P 500 outperforms the Dow Jones, or as this chart shows, the Dow Jones underperforms the S&P 500. Right, the first thing that stands out to me as a theme for this presentation are the number of indices that have had a breakaway gap like this. Okay, there's a gap and it's gone to a new high. So if I had to put a swing chart on this, you'll see that in that one foul swoop, we've completed the trough, higher trough than the previous trough, and we've also had a higher peak than a higher peak there, and this already has a higher high than that. So wherever this goes to is going to form another higher peak, and we obviously do have as we do in all the charts, this is an open open trade on SPA3 Investor, and let's just get rid of that. And so you can see this is going to be the theme. So let's have a look at the S&P 500, zoom in a bit more here. Similar thing, higher highs, higher lows, and a breakaway gap over here, and about 50 points off its all-time high close, which happened back here in March of this year. Volatility falling away, which is what typical of a rising market. And if we have a look at the cumulative new high, new low, there's no divergence there. This is rising, that's rising. And so no divergence there, nothing to no early warning signals there. How we have on the cumulative advanced decline line, both rising, so no divergence there. You can see with this, what is divergence? This is divergence when the index is rising, but the cumulative advanced decline is falling. That means there are more stocks falling than rising, while the index is more stocks falling than rising, while the index rises. And that is divergence, and it did this particular occasion. It did work. We had that fall there. So there's none of that in place at the moment. We do have negative divergence on the number of stocks that are above their 150-day moving average, where the peaks here are falling and the index is rising, but it has a very low occurrence of signaling bear markets at that. But it's still a breadth of market indicator showing half the stocks are above their 150-day moving average, or just over half, which means there's some potential upside for that other half to get to that as well. Okay, looking at the US dollar index, we've got them going in opposite directions, which is exactly what we want. There's the risk-on signal, which happened back in May, 6th of May, some 7 weeks ago. and that is certainly what's happened. We've had the index continue to rise since then, and the US dollar fall. We want them going in opposite directions if what we want is rising equities, rising stocks. Okay, this is the growth. This is the Russell growth versus the Russell value. Risk on happened back here also in May, it's May. Rising, you can see the relative strength rising, the moving average of the relative strength rising, the Siroc rising, and you can see at the naked eye that the growth is outperforming the value. So that is another risk on indicator. The same with the consumer discretionary versus consumer staples. That risk on happened also in early May. Although this is going sideways, it's not rising consumer discretionary, but staple is falling. That's what's causing the relative strength line to rise and that risk on to happen. So that is also a risk on situation. This is the put call ratio. And right there's a similar, so we can see this over here, risk on is a call. What that means is there are more calls than puts being bought. And this is another indicator I use where effectively where the green line, the shorter term moving average is above the longer term. That is also, you can see the fall over here. So what have we got? They've got a 250-day. The blue is a 12-month, an annual moving average, and we've got a 21-week, which is just under half a year, so about 6-month moving average, and they are both declining. So that is also a risk-on environment. Okay, turning to interest rates. So this is the yield on the 10-year Treasury note. There, the risk-on happened over there, where the Treasury, where the yield started underperforming the index, and of course we've got that rising, another risk-on. So, and the same with 20-year Treasury bond. So we want bonds and stocks to be going in the same direction, because when bonds rise, it means interest rates fall. So this is also risk on. They're going in the same direction. We've got falling volatility right in the smack middle of this range over here, and you can see the moving average, which is a 21-week moving average, is falling as well. So falling volatility as per the VIX index. And we have on the Nasdaq Composite index, we are an open trade. Also, risk on happened back here in when is that? That's also 20th of May, a bit later. Now I said the S&P 500 is about 50 points off its all-time high close. The all-time high close, we'll just clear the chart here, is back over here on the Nasdaq Composite, and that was at 2174, let's call it. And so we're about 260 odd points below that, 260 points below the all-time high. So it's getting up there, but here we have a gap, a breakaway gap to a new all-time high. And we'll have a look at the swing chart as well. Look at these higher highs and higher lows all the way. We've got another higher high. This is so different to a top like that, like we had over here. So this is all risk on. Let's have a look at the Nasdaq 100. And the Nasdaq 100. Sorry, I should also. No, we won't get we don't have to worry about it. Got risk on here. What does this risk on mean? This means that the Nasdaq 100 is outperforming the S&P 500. You can see this rising. That started from just after the dip, round about here. Where am I looking at? I'm looking at here, and that was in late April, so about 2 months ago. We had the Nasdaq 100 starting to outperform the S&P 500. Tech is on again, and I'll show the next sector index will prove that to you. But what do we have here in the Nasdaq 100? I'll just clear the chart. We just clear the chart. Is we have a new all-time high close, right? The previous one was here at 22,175. You can see on the right-hand side 22,190. So where all those people that were saying the tech was done, tech was over and done with. Because they knew what was going to happen. Obviously, I have discussions with our customer base, and and there are one or two customers that I've had discussions with, long-term customers. I mean, long-term, like 15 years plus, who just could not take what was going on politically in the world. Their political worldview just did not align with what is going on, not only in Australia, but in Europe, the UK, and also in the United States. And they just could not handle it. So what did they do? And this was back here just after Liberation Day, right at these troughs. And even these people who I would say are pretty close to 100% mechanical traders who can stay in the flow for long periods of time, it got too much for them. And they stopped investing. They pulled out. They said they're taking 100% of their money out of the market, going to sit on the sidelines and wait and see what happens. Because of their worldview, they knew what was going to happen. Could only be in one direction and not good for them. Well, I make that point because that's what we say all the time in our trading, in our training. And Dave and I repeat it ad infinitum. In these sessions, in Dave's sessions that he does as part of the Learn to Trade Properly webinars, and we've been saying it for years and years, and still, people still struggle with it. And what have they done? They've worn some or part or all of that drawdown, and they've foregone all of the run up because why? Fundamental truth number 2. You do not need to know what is going to happen next in order to make money in the market. But we, over and over again as human beings, think we know what's best for us. And in some parts we do, but not in all parts of our life. Just because in one part of our life we are correct in what we think we know what's good for us, it doesn't mean it's going to be the same in the market. And I just know from the traps how negative people have been around about the markets for so long. So this is the other thing to point out over here, which is the theme, is this is a breakaway gap to a new all-time high. This is important. This is big stuff, right? Now, there's no 100% dead cert that this is going to carry on and just go gangbusters. It could be resistance anywhere. Of course, there are variables going on all over the world all the time. Anything can happen. But on a probability basis, looking at technical analysis, looking at charts, and having done this for 35 years now, I can tell you that when you have a gap like that to a new all-time high ever reached, that is significant. And you should be in the market. If you are somebody that watches the market, keeps an eye on the market, has been active in the market for weeks, days, whatever, particularly if you've been in the market for decades, you do not want to not be in the market now. I don't know how else I can say that. This is significant. And this is not the S&P 500. This is supposed to be, the risky part that follows, if you like, what the broader, like an index like the S&P 500 should do. So if the highest risk part of the market is making new all-time highs and a breakaway gap, you ought to be taking notice, and you should be in this game right now. You should be in the flow. And you should be following whatever process it is that you have. You should be in it. So, what is what is this? This is the cumulative new high, new low on the Nasdaq 100, and you can see this is dipped and is slowly starting to rise, and it's doing that, on bringing the broader market on, and the cumulative advanced decline line also rising on the Nasdaq 100, and the breadth of market. There's no divergence here. This is going to higher highs. You can see there's a higher number of stocks on the Nasdaq 100 percentage-wise that are above their 150-day moving average than what they are in the S&P 500. Another positive. And then I come to the SOX, which is the semiconductor sector. This is a sector of the Nasdaq 100, and this was underperforming. Look at this, underperform for all this time. What date was that? That was in June of 2024. That's a year ago. So we've had this underperformance of the semiconductor stocks, and that's mainly indicative and a proxy for the high tech part of the market. And now it's starting to rush back. So it's starting to outperform the Nasdaq 100. So you've got this sector outperforming the Nasdaq 100, which is already outperforming the S&P 500. So let's just go back here and look at what happens when the SOX, as it's called, the semiconductor index, starts outperforming. So here's the early adoption off the trough. It starts outperforming the Nasdaq 100. Then there's a bit of kind of goes sideways, underperforms, then it has another kick up, right? So this could be, I'm not saying it's a dead cert, this is what it is. is that this early stage here could be similar to this early stage over here where it plays catch up. And this underperformance, look at that underperformance. So when the market was going down, the tech sector, the semiconductor sector was going down by more than the Nasdaq 100. Now it's starting to rise. Again, this is also, I'll just go to a clear chart here, another gap, not quite at all-time highs, and that's the next thing we've got to be looking for, is going to all-time highs. I've also included, brought in the TSE 60, or the that's called S&P TSX, which is the Canadian Toronto Stock Exchange, and it has made a new all-time high as well. Now, this is the broader market. It's not a tech index. This is industrials and miners and everything in Canada. New all-time high. Again, this is not a market that you should not be in. Now, let's have a look at the All Ordinaries. All Ordinaries over here underperformed the S&P 500 and now has been kind of matching to falling, but you can see the lower lows are a bit higher over here, so forming a symmetrical triangle, and is not that far off all-time highs. There's the all-time high back in February, and here we are now. We'll have a look at this because this is a more interesting one. We'll go and have a look at a swing chart. Look how long this swing was. Massive. It is so seldom you see that on the All Ordinaries. It's just one of those things that does not happen that often. Just go have a look at all these over here. Even that was smaller back over here, coming out of 2022 and even out of COVID. Which is coming to it. Let's just do this. Coming out of COVID, it didn't even have such a long, run-up 3-day swing. This is significant. This is significant price action, and we are not at all-time highs yet. So what else gives me some confidence in this is that we are in a secular bull market. So when you see primary bull markets doing this within a secular bull market, and we know the secular bull market is not over yet, and in fact what the price action has happened in the last couple of months would have taken that even more off the cards at this stage, technically speaking, not dead cert speaking, probability speaking, comparing it to the past, which is not 100% reliable indicative of exactly what's going to happen in the future, but on a probability basis, there is a high probability this is going to go stronger. So what do we have here is we are a new breakout to a new all-time high. What we're going to see is after that happens, and I think the odds now are pretty high that it's going to happen, not a dead cert again, is that we'll see a retest of these resistance levels become support levels. So you want to be in this market, and I know people who are not in it are going to be sitting there quite tentatively saying, is it too late to get into it? Well, you need to examine if you're sitting on the sidelines and you're 100% in cash or 90% in cash for your liquid money that you actively invest with. I'm not saying all your money. You need to now go to your trading plans, your investment plans, and you need to come up with some guidance to yourself now when you're in the middle of this, as to because you're going to find if you have not yet built the habits and you have not yet attained the skill set of consistency, then this is going to happen again in the future. And so you need to either decide to right now step into a process to become better at becoming consistent and to build the skill so it becomes a habit, and that you don't question it when your worldview doesn't agree with whatever's going on in the world, and then let that overflow into your investing decisions. That's not what you want to happen. Because the economy and the market are never in sync. The geopolitical happenings around the world in the market are never in sync, right? And when they are, it might be for short periods of time when the sun and the moon and the stars are lined up that that might meet your perfect conditions. That's not how you invest. So if you find yourself on the sidelines now, waiting for better days because you knew better that it was just time to be out of the market, then go to your investment plan, examine what you have there, and come up with some plan. You've got all the tools. I'm not going to be able to say to you, because you missed the boat, because you made a big mistake, that this is how you should fix it. You've got to work out how to do that. You got the rules, you got the signals, you got the indicators, they're all there. And what you need to do is within those bounds, work out how you are going to get back into the market. Is it, you're going to take all of your investable capital and put it in on the what, when, what's going to be your catalyst to do that? Or are you going to take some of it and gradually go in and then build up? You have to work that out. You've got the boundaries, you've got the signals, you got all of the education we've done. It might just be stepping into a process to say, I'm going to go and sort out my skills. I'm going to make them much better than what they are now. Whatever it is, you should be doing it. But if you find yourself on the sidelines now and you have been an active, if you like, watcher of the market, and you've got capital available that should have been in the market, then you have made one big, massive mistake in missing this run-up. That's what's happened, right? So you need to fix that. You need to fix that mistake. And you can either do nothing about it, or you can do something about it. And that, I would suggest, is to step into a process to up your skills on doing that. Right, the Aussie battler is showing a bit of strength. There's an entry signal there, and it's in a very gentle uptrend. Of course, most of that comes from even more weakness in the US dollar than anything else, because that is against the US dollar. The right, going on to the Nikkei. Nikkei has really found a lot of resistance around this all-time high from 1989. Look at this. It's gone above and below it a few times, fallen obviously with when all the other markets fell, and has risen again and is toying with it again, but underperforming the S&P 500 at this indecision point. The DAX is not quite an all-time high yet. All that outperformance early against the S&P 500, and now is not far off its new all-time high. The FTSE has been pretty strong. Some weakness overnight. It didn't gap. It actually fell back to its opening price, but very close to all-time highs as well. And here is the Bovespa. There's all-time highs that it's at. It's made a new all-time high there and has fallen back, so not quite at it. It's an open trade and underperforming the S&P 500, proxy for developing markets. China also, should take that off. China also rising. There's a gap in the broader China. Oh, sorry, that's the large cap Chinese market, the FTSE China 50, and this is the broader Shanghai index, which is also rising as well. We've got all indices rising, and this is the Hang Seng also rising. I put that in, one to take nowhere near its all-time highs. Look at this long-term sideways movement over here since 2007. When that was. It's it's 18 years now. Anniversary of won't go into that. And we have the South African market also near all-time highs as well. It's made these all-time highs looking similar to the TSE, and quite often it does. At periods look like the Toronto Stock Exchange, being resource-based market, and big up night, and also pretty close to all-time high. Right, now let's just quickly go through commodities. Whoops, I should go to the CRB. That's the one that we'll finish on. Some opportunities there. Right, this is the CRB index. This is a weekly chart, so it doesn't have the fall in oil in here yet. We'd only get weekly data on this, and this is so obviously rising on the back of oil around this point here. It's been there for quite a while now, since June of 2022. So 3 years it's been wandering about around this point and not going anywhere. So resources really in a long-term sideways movement. Gold, I've got gold in in this trading band. We'll go to here to zoom in too much. There's the 3-day swing. Here is it's going sideways. I actually adjusted this channel. I did have the lower channel line over here somewhere, and it had fallen through. So I've actually dropped it a bit to here, and it looks like it's falling through there. This is this is, keep an eye on gold. This is a negative sign. This is a signal. If you are using trend lines as your main indication of when to buy and when to sell, it is there's the first sign. But you wouldn't sell on that. You'd wait for it to fall below at least 1, 2, maybe even 3 lows. So you could wait for this, and we could end up in a sideways moving rectangle, which is a continuation pattern. Anything could happen from this. You could also in here draw an ascending triangle as well, which is a bullish pattern. But so we have to wait and see what happens on the next in the next 3 or 4 weeks on gold. And silver is trying to catch up, although it hasn't. It's been underperforming gold all this time, going back to 2020, and little spurts where it outperformed just a little bit, but underperforming is a little spurt here, but mainly underperforming gold. So the old proxy that gold goes first, and then silver catches up with gold. We'll have a look at a chart at the moment, which looks like it's having a bash at catching up with gold. Silver certainly isn't. Copper is, there's all-time highs. Also, a lot of resistance around its all-time highs and underperformance of gold as well. I'm just looking at it compared to the main, if you like, resource that's been trending strongly. This is oil. Oil had this big run-up with what's happened in the Middle East, and now that things look like they may be sorted out for a few hours, it's fallen again. It's staying in this long downtrend in oil. This is Bitcoin. It's kind of held through. We're still trying to work out what Bitcoin does in during times of war. And remember, war has its biggest effect at the start of the war. And as wars move on and stay around longer, the world and world markets and people and everybody, human beings, basically, therefore markets, become desensitized to it, and they kind of gets just taken into, becomes normal. Well, that's not quite the case yet in the Middle East, although the war against in Gaza and all that has been going on for some time. What's happening in Iran is a pretty new war, and we're just looking to see how certain commodities, and Bitcoin is commodity inverted commas, not quite, is actually taken it in its stride so far, and it seems to react to other variables rather than war. And this is Ethereum and a little bit of a downtrend as well. That's also in a downtrend, just going into uranium. Uranium fell through this support level. Let's just zoom out. You can see where uranium is. Obviously, there's the all-time high back in 2007. Massive run up there, down, and slowly been building a base. We've got to find out where that base is. It's support and resistance there. There's some at these levels. It's fallen through this resistance now, then support, but coming back into it, and it's broken that down channel, so it could be rising again. This is iron ore. This looks like this band of between 95 and 125 thereabouts is forming a strong base for iron ore, but that could all change if we fell below this 95 level. This is thermal coal. Fell below there. That was that channel, that sideways moving support resistance zone, and it now looks like it's found support here at around about $100. And the one that I want to focus on today, which I did mention in the last session that we did a month ago, is platinum. Platinum also has a bit of history and reputation for catching up and then even leading gold, but generally goes roughly in the same direction, not at the same rate or pace. So the green here is gold, and the red in the actual bar chart that I have below it is platinum. So look what gold's done. And look at this massive, so we're looking now going back to 78, out and underperformance, there's outperformance, kind of underperformance, sideways, down, underperformance, and then massive underperformance. So this underperformance here is, what are we looking at? 50 years has been more prolonged than any other previous time that we have data on. That's nearly 50 years, 47 years. And so the theory is that platinum could do some catching up here. And so, but let's don't just bank on that. Let's go and look at the price action. So if you look at the price action, and I know I have some ETFs overlaid here. So there's an Australian ETF, ETP MPT, and that's the orange line. But we can just, if we take that out and we look at the raw price action, the black line is the PPLT, which is the US dollar ETF. And that is following platinum pretty closely. It tracks it quite well. And then let's just have a look at the Australian one, which is Australian dollars, and it is slightly outperformed due to exchange variation. But these are breakouts that are occurring over here. This is the ETP MPT which is in Australian dollars. Look how it's broken out as well, and there hasn't been much variation between the Australian dollar and the US dollar to cause that. That's coming from price action. So if you follow the space, I know we've got customers who do follow commodities. This is one commodity to really keep an eye on. The breakout that happened in gold above $2,000. Let's just go and have a look at it. It's when this happened. I'll just get rid of that. Yeah, this was a key breakout. Look at it. When it broke. I mean, that was, and we mentioned it at the time, that was in February last year. That's just, what, 15, 16 months ago. And it's been a great breakout. I mean, that is just classical price action. So if you missed that, if you missed gold, then here is a chance to play gold, if you like, but through platinum. Now, you should still have some rules around what happens with this price action in platinum over here. We've had a few other little spurts along the way. It could all fall in a heap. But if the theory goes that and it's still a metal that's in demand right across green energy and green whatever's in the whole toot, as well as traditional, then keep an eye on it. Right, that's where I wanted to finish today. There are some PS. Bruce is saying long upswing equals few investor signals. Correct. No trades for greater than months enjoying the ride. Yeah, thanks, Bruce. That's good. And also, he says, PS, 100% invested. And that's where you should all be. If you're not, have a good think about it. Right. Are there any other questions that anybody has to ask? I'm happy to finish it there. And of course, you've got to be in this market theme. Breakaway gaps near all-time highs, and even Nasdaq 100, making a new all-time high with a breakaway gap. That's significant. It really is. So I'll finish it there. Thank you for your time and attendance. I'll finish there. As always, I wish you objective, consistent, and peaceful active investing.